Hello, good morning, and good afternoon to In-House Counsel from all across North America. Welcome to In-House Connect. My name is Shai Mahani. I'm the CEO and co-founder of In-House Connect, and I'm thrilled to have you here with us today. Thank you for spending your breakfast time or your lunchtime with us, and special thanks to our wonderful sponsor, Risk Settlements, and our fantastic presenters today, Ross Weiner and Kevin Skrzewski, for putting together a fantastic presentation on how to leverage risk transfer solutions to reduce risk and create certainty in litigation. For those of you who are here for the first time, let me give you a quick bit of background. In-House Connect started 11 years ago as a New York City-based meetup group for in-house counsel. Every month, In-House Connect would organize free CLE classes hosted by different law firms, which were followed by cocktail networking receptions. And every 6 months, we would organize fun and festive networking mixers. Over the years, we've helped thousands of in-house counsel connect with peers and outside counsel alike. The group was humming along, and then, of course, COVID hit. We couldn't meet in person, so we went online, and it's been a fantastic transition. We've been able to attract a much larger audience of in-house counsel, truly from coast to coast, and we've been able to feature high caliber speakers like the two we have today, who I'm going to introduce in just a few moments. This is our 27th event of the year so far, and I'm wondering, is this your first IHC event? So let me know in the poll. And it looks like we have 30%, make the math easy on me, 30% first timers. So welcome. Hello to the 70% returning viewers. Great to have you back. And that's that. So today's event, Litigation Essentials for In-House Counsel, how to leverage risk transfer solutions to create certainty and reduce risk in litigation. Our presenters today are Ross Weiner and Kevin Skrzewski. Ross Weiner is a legal director at Risk Settlements, where he helps evaluate new business, assess legal and financial risk, and create optimal settlement designs and risk transfer options. Prior to joining Risk Settlements, Ross spent 9 years as a litigator at Kirkland & Ellis, where he focused on, among other things, class action disputes. During that time, Ross came to understand the importance of providing clients with creative approaches to settling disputes. At Risk Settlements, Ross is able to provide companies with these insights. Our next panelist is Kevin Skrzewski. Kevin is the National Director of Business Development and Marketing at Risk Settlements. Using Risk Settlements' proprietary quantitative and qualitative analysis and more than 20 years of legal and business expertise, Kevin assists companies and their counsel in designing optimal settlement strategies to mitigate financial risk arising out of class action settlements. Prior to joining Risk Settlements, Kevin has worked with law firms to design customized business solutions while working at Bloomberg's legal division, Thomson Reuters, and LexisNexis. We are so fortunate to have two fantastic risk transfer solution experts with us on today. So with that, I will turn things over to Kevin and Ross to get us started.
Great. Thank you, Shai.
Thanks, Shai. It's great to be with you and great to be with all the in-house counsel who have Zoomed in today at breakfast or lunchtime. Let me just take one more minute to give a little more background. Risk Settlements is a company that was founded in 2014. We're headquartered in Plano, Texas. I'm coming to you today from New Canaan, Connecticut, and Kevin is in Ohio. Our team includes former civil trial lawyers, AmLaw 100 defense attorneys, state Supreme Court judicial clerks, and insurance professionals. So we kind of run the gamut, and we have, a lot of experience in helping expunge litigation exposure, and that's what we've been doing since 2014. Now, we are hoping that today's presentation will be as interactive as possible. And so, as Shai mentioned, if there are questions, feel free to use the chat function during the presentation. And in that same vein, we have put together a number of poll questions that we'd like to make this interactive. And so let's start with poll question number 1. Next slide. Is that coming up on the screen yet? There it is.
It looks good.
Poll question number 1. Have you ever had the need to transfer the outcome risk of any of your companies or clients' known, threatened, or pending litigation? So I'll give you a minute to weigh in on that. All right, looks like the answers are starting to slow. So it appears that, roughly 75% have said no and 25% have said yes. So interesting finding. Well, I hope for the ones that have said no, that maybe today's presentation will help think through, maybe there are some opportunities out there that haven't been top of mind, but could be in the days to come. So with that, let's start the presentation now with Kevin going through and sharing some interesting findings from a survey that we helped commission among constituents in the industry on risk transfer.
Thank you, Ross. I appreciate that. So speaking of polling, we recently commissioned a litigation risk survey for in-house and other general counsel attorneys, mostly in the United States, but actually we also extended it to some of our global clients as well. We did it in conjunction with legal think tank In the House. And we thought this year was especially critical since we know that litigation basically was at a standstill in 2020 and 2021. Most of the cases that were on state and federal dockets were moving at a snail's pace if they were moving at all. Yet there was a host of COVID and non-COVID related litigation that was being piled on top. But that as things have opened back up in 2020, people have begun to move at a more traditional cadence, if not even at an increased operational tempo, given the waterfall of litigation that is coming down the pike right now. So what we did is we developed the survey. It included about 50 different questions, which measured things such as budget, staffing, risk tolerance, the awareness of alternative litigation risk transfer solutions. And we received almost 200 responses from general counsel and other in-house lawyers that were from both small, mid-sized, and large companies, spanning about 50 different industries. So it was a very good wide swath of responses. And we wanted to start by asking a couple of things, basically focusing on whether or not the size of the legal departments corresponded to the size of the corporations themselves, and then moving on to some questions about budgets and about litigation volume in and of itself. And unfortunately, what we had found is that of all of the respondents to the survey that we received, about 80% had fewer than 10 in-house lawyers, which was very surprising given the fact that about 50% of all of the companies had over 1,000 employees. And so we definitely found that there was a lack of correlation between size of legal department and size of the overall corporation. So next we had move on to budget to see if, well, perhaps maybe if there's some issues with understaffing, there aren't similar issues with budgeting. But unfortunately, what we found was that budgets were also relatively small, and that 50% of all respondents had budgets of less than $1 million annually, which are pretty small. Now, given that does not include salary and benefits as well, but still, we also found that only 10% had 10 million or more in budget. So we definitely saw that there was a pain point in terms of understaffing and in terms of being under budget as well. So then when we moved on and we looked at, well, how many cases overall are the companies defending? We found that the responses were rather daunting in that about 75% of all respondents were defending some type of litigation, but that 20% were defending between 10 and 50 or more cases, which is a lot of litigation, especially considering the fact that most departments had fewer than 10 attorneys. So I think the results that we found in terms of staffing, budgeting, and litigation volume have been very consistent with a lot of other surveys that have come out post-COVID. In fact, there's one on our slide right now from the Association of Corporate Counsel that found that more than half of all in-house lawyers were seeing an increase in the number of hours that they were working. And a rather scary number, about 3/4 were showing moderate to high signs of burnout. So then what we wanted to do is we wanted to move on and see, well, what are the most important factors that they employ when they're choosing outside counsel? And how often are they able to leverage insurance to cover the cost of litigation? So what we found was that having an expertise in a particular area of litigation was the number one criteria that in-house lawyers were looking for when they're selecting outside counsel, followed by whether or not the lawyer or that law firm had a prior history with the business, and then followed as a distant third to what different types of cost arrangements they were able to structure, including the use of alternative fee agreements. But I think what we need to look at is between expertise in litigation and prior history with the firm is to read between the tea leaves a little bit, because I think what we also see here is not just whether or not outside counsel has an expertise in the matter at hand, but in whether or not they have an expertise in the history of the litigation that that business has faced. And when a lawyer has an understanding with that, that often does tie into whether or not they're experts at the litigation, but also whether or not they know their business, and they know their market, and they know their competition as well. And so I think what we see from a lot of CLOs is that they rely on their own experience with specific outside lawyers or law firms, or their personal knowledge of the lawyers or the law firm's reputation. And so I think when it comes down to selecting outside counsel, there are some subtle nuances in between the statistics that you see here today. Then when we moved on to see how often insurance is leveraged in litigation, I think in theory, organizations purchase commercial liability insurance to protect themselves from the full cost of potential claims, either against the business or their employees or their executives. However, in reality, I think most of the time, insurance is only helpful to defray some of the costs of the litigation. In fact, in the survey, we asked the specific question, what percentage of the time are you able to utilize an insurance policy to cover the costs of defending a litigation? And by a wide margin, the respondents said that they relied on insurance less than 10% of the time, and only 1 in 4 said they relied on insurance to cover more than 50% of the costs of the litigation. So I see, again, that insurance is very rarely able to be relied on to cover a significant portion of the litigation. Then we moved on to look into, well, who at the organization assesses the litigation risk? What are the risk factors that they consider? And what is their risk tolerance? Now, I don't think there's a lot of surprises necessarily with the results of these questions. I think it's pretty obvious that in the large majority of cases, the general counsel is the individual who assesses the risk. We see that the general counsel sometimes relies on a member of the C-suite or the entire C-suite about 30% of the time. But I think it's been our experience that this is normally with a smaller or a mid-sized organization. Normally, if we're working with a larger business, we see that the decision goes to a specific head of litigation or a head of or a head of risk management. But now, keep in mind, this specific question was who assesses the litigation risk. In hindsight, I do wish we would have asked an additional follow-up question to this, which would have been, who makes decisions, strategic decisions regarding the litigation when you're further down the litigation roadmap and you're at a certain inflection point where there's an off-ramp to perhaps consider a very cost-efficient settlement structure? Because it's been our experience that when it comes time to considering settlement versus pursuing the litigation, in those instances, whether it's the head of litigation or the GC, they almost always report back to the C-suite and or the board of directors. Then we look at the top risk factors that they consider when defending cases. And with that, we see that size of damages or the bet the company litigation definitely rules the day, followed by the likelihood of prevailing, which is a little bit opposite when we consider whether or not in-house legal departments are considering affirmative claim monetization, which is a topic we're going to cover a little bit later down in the presentation. And when companies are deciding whether to monetize latent litigation assets, those numbers are actually flipped, and they actually consider the likelihood of prevailing to be the #1 criteria, and then the size of the damages is a much more distant second. And then lastly, when we were looking at what is the company's tolerance for litigation risk, this was split pretty evenly across the spectrum. So what we see here is that about 50% of all respondents said that they were somewhat tolerant of litigation. And then the remaining answers were split relatively evenly across the polls. So we see that about a quarter of the respondents said that they were either very tolerant or extremely tolerant. to litigation risk. And then a quarter at the other end of the poll said that they weren't really very, very tolerant at all. So that it really is a current litigation risk market overview as seen through the eyes of the in-house attorneys who responded to our survey. Now I'm going to turn it over to Ross to discuss some of the different approaches in assessing litigation risk and some of the different solutions that are available in the marketplace to mitigate, cap, and transfer those risks.
Thanks, Kevin. So on the next slide, which we titled Litigation Risk Assessment, we've got kind of two contrasting approaches. One is what we call the typical litigation approach, and the second is the paradigm change. And the way I like to think about this is a little bit like old guard versus new guard. As a defendant in litigation, we'll focus on being a defendant for the time being. Most often you're forced to play defense. You're reactive, you're reacting to the complaint, you're hiring attorneys on a time and materials basis, which can be very expensive. You're weighing questions about whether an early dispositive motion would be worth the cost, but with the understanding that the longer the case goes, the more it'll cost you. And traditionally, when you're defending a case, there's not that same built-in alignment of interest with counsel. There's certainly no guaranteed outcome, but the no alignment of interest point is really about how, the longer the case goes, in some ways, it can be good for counsel. They get to try out a lot of arguments. They can make a substantial amount of money while defending the case, but you're kind of along for the ride and hoping for the best, but in some ways expecting the worst. And so what we're here to talk to you about a little bit today is the paradigm change, which is the new guard. It's about transferring some of the risks so that you put yourself in a better position financially. So transferring outcome risk to an insurance carrier, which can make your company more attractive. And so, the bullets we've listed here are, ring fencing known threatened or pending exposure. And we will get to a product that can help you do just that through the use of novel insurance strategies. And on the plaintiff side, it's about monetizing latent litigation assets and harvesting value out of potential recoveries. And so that's really about taking claims that you might not otherwise want to bring, or class actions or antitrust matters that you might not want to participate in, and coming to the understanding that these can be valuable company assets that can help your position with the CFO, when instead of going to him or her about a cost, that's going to go with defending a case, it's about bringing assets into the company. And finally, on the alignment of interest point, the way insurance products and monetization work is that they shift the risk of loss, or shift some of the risk of loss, to lawyers, carriers, funders, and in some cases, all three. And so, that's about sharing some of the risk. It's also, obviously giving up some of the upside, but it's making your position more certain when it comes to litigation. So the rest of the CLE will get into some of the products, how you can go about doing this. But before we get there, let's segue into our second poll question, question number 2. Which of the following litigation risk transfer solutions are you familiar with? And so we've listed some of the products that our company offers, but if you want to weigh in there, I'll give you a minute. All right, let's give folks, the responses are starting to slow. Let's give 5 more seconds. Okay. So interesting. I don't know if you can see the results on your screen. Kevin, can you see them?
I can.
Okay. So, it looks like, as expected from our view, litigation funding is the most well-known for sure. That 58% are familiar with. Class action settlement insurance, a product that our company helped create. That's fairly well known at 35%. And then the rest are a little bit less well known. And so that's obviously a good thing, because we can get into them today and help explain it. And as Shai mentioned, Kevin and I are available on this CLE to answer questions, but of course offline as well if there's stuff that you want to talk about. And so with that, let's turn to slide number 9. The different types of litigation risk transfer. All right, let me close out the poll. So here we have kind of an overview of the various products we're going to talk about today. And this is what, part of what I call the new guard, right, of the types of litigation risk transfer products that are available to help offload some of the risk inherent in litigation. Now, while we're going to talk about each of these types of products specifically, I want to take a minute to make some overarching points about them. And so, one of the most interesting aspects of the new guard of products is how wide-ranging and available these products are, regardless of A, which side of the V you're on in a litigation, B, which stage of the litigation you're at, and C, what type of desired protection you're looking for. So let me break those down a little bit. For the side of the V, if you look on this slide, the first four products, class action settlement insurance, litigation buyout insurance, prospective coverage, and adverse judgment insurance, those are for defendants, while the last three, judgment preservation insurance, claim monetization, and litigation funding, are generally for plaintiffs. And so, there are products out there for folks no matter which side of the V you are on. The second overarching point is the stage of litigation at which the products are available. And I found this interesting. It runs the gamut, as you'll see, from pre-lawsuit with what's called prospective coverage, where you have an inkling or there's some rationale for why you might want some insurance coverage for a potential claim that has not been issued yet. You can seek coverage even before a lawsuit has been filed. And it runs the gamut from prospective coverage to post-judgment, which is the judgment preservation insurance. Again, we'll talk about that later, but that's after you've already had a full trial or a arbitration hearing that's up on appeal and you're worried about preserving the hard-won judgment on appeal. There's a product available for that as well. And finally, as for the desired protection, right, it runs from insurance, which you'll see the first five products are insurance type products, where a third party carrier will pay in the event that some event comes to fruition, while the last two products, claim monetization, litigation funding, are more about a third party providing capital at point X with the goal of earning a return on that investment at some point in the future, point Y. And obviously the win-win scenario there is it allows a claim to go forward, it allows it to be funded, and ideally the litigant will do well financially there, but the funder will as well. So that's the desired win-win scenario of litigation funding. So, with that, let's turn now to the next slide, where Kevin is going to start going through the products that are described on the previous slide. And the first one will be class action settlement insurance.
Sure. Thanks, Ross. So very interesting to note, first of all, that about a quarter of all of the participants on the webinar are familiar with class action settlement insurance. So perhaps we actually have a few clients on the call, which is great. So class action settlement, or CASI for short, is a way for a defending business to transfer 100% of the financial risk in a claims-made settlement structure away from the actual business to a carrier in exchange for a one-time payment of a premium to a bespoke manuscript policy that covers the entire aggregate settlement liability of the case. Now, CASI is available for many different types of cases. It's very popular among statutory cases where statutory liabilities are high. So we insure quite a few TCPA cases, FDCPA, RESPA. It's also available for the entire gamut across the consumer class spectrum. So any of your false advertising, mislabeling, fraud, products liability, product defect, breach of warranty. It's a very effective tool to expunge all of the settlement risk in those types of cases. And we've actually seen an increase in the number of businesses who are leveraging CASI over the past couple of years. And I think that's because we're also seeing an increase in the number of claims-made settlement structures as opposed to common fund settlement structures. And that could be for a wide variety of reasons, but I think one of them might just be that in a claims-made settlement structure, if you have a very meaningful and a clearly defined benefit for each class member, then it's a very equitable way to distribute the benefit to the class. Whereas if you settle according to a common fund structure and there's a very high volume of members that participate in the settlement, then the individual benefit to each member could be de minimis. But conversely, if you have a very low volume of class members participate in the settlement, then that could actually result in a disproportionately large benefit to each member. The issue with claims-made settlements is that it's very difficult to predict what the ultimate financial cost is going to be. And there's a variety of factors that can play into that. One might be the type of notice, whether it's a direct notice or whether it's a publication notice campaign, or you could look at any of the individual elements of the notice itself, the claim process or the administration process, not to mention the safeguards and the controls that are built into the entire notice and admin process, especially
Kevin, I was going to just note that this is answering Genevieve's question, who asked how much might this cost generally. So we're getting to your question right there.
Okay, that's great. So I'm just going to point out that I think the largest percentage of our docket, Ross, of the cases that we're tracking, some of the cases that we're working on, are related to food and beverage false advertising. That industry has really just blown up over the past few years. And there's a lot of usual suspects out there who are filing a lot of these cases, and the growth of them has really proliferated. But with that, you also see a lot of fraud in publication notice campaigns. And so I noticed from my teenage daughters themselves, they see advertisements on TikTok and social media and Facebook, advertising ways that you can submit a claim, even up to and including literally, here's how you can grab free money. So there's so many factors that can go into what the ultimate financial cost of claims-made settlements could be. But when you're able to couple that type of settlement structure with CASI, it's just the perfect way to mitigate, cap, and transfer that financial risk. And the reason why most businesses leverage that insurance solution is because they're able to obtain absolute cost certainty. They're able to exit the case just for what the cost of that bespoke premium is to that policy. But also, and I'll move into a case study to give a good example, they're able to mitigate their P&L and their balance sheet impairment. So let's go ahead and take a look at a case study as well. So normally, when we're working with a business, the biggest impediment to resolution is the uncertain cost of settlement. And so often when we're working with outside counsel, they're focused on the legal issues, but they aren't necessarily hyper-focused on the things that the business is concerned about: the budgets, the expenditures, the financial forecasts, operations, all of their constituent accountability with the board and with shareholders. But most importantly, what are the negative financial implications that a traditional settlement could have on their P&L? Now, caveat that Ross and I are not accountants. We're both lawyers, but we work with accountants and auditors all the time on active class action settlements. And most tell us that they require the businesses, even in claims-made settlement structures, to book the entire amount of the aggregate settlement liability on their books immediately. They have to take that balance sheet charge. And so that impacts the financial health of the organization and their risk. There's a lot of factors that can go into a business's risk tolerance, whether it's the size of the business, their financial health at the time of settlement and things. But when they have to take that charge on their P&L, it can cause some unintended consequences of settlement. And we've seen things such as common as just cash flow issues, just other balance sheet impairment, weakened financial statements. Maybe there could be an adverse impact on raising capital, a missed earnings forecast, something along those lines. But there's even more severe cases where a business could be looking at bankruptcy or breaching a loan covenant. And so to our case study, we were recently working with a consumer manufacturer, created a product. There were allegations that the product was defective and the defect could cause injury if misused or mishandled. There was some liability involved, and so the plaintiff was insisting on a very large settlement, which would be detrimental to the defendant's business. And if the defending business had to book I think at the time it was a $30 million request for a common fund settlement, they actually would be in danger of breaching their loan covenants and, in essence, handing the proverbial keys to the business over to the bank. And so they had reached out to us, and we were able to structure a claims-made settlement, which is just as large, just as robust as the common fund. We had a liability cap of about $30 million, but for the business, the premium, of course, was only a fraction of what that aggregate exposure was. And so the business no longer had to book that contingent liability, which would have caused them to breach their loan covenants and default on their loan. The amount that they needed to book, the premium for the CASI policy, was more palatable, and they were able to maintain cash flow, keep the business open, and keep their operations moving forward.
Let me just address one quick question I'm seeing, which is, does the insurance company investigate invalid claims to minimize their payout liability? The short answer to that question is no. In every settlement we worked on, there's always a third-party administrator that's hired to do that. And so the insurance company ultimately pays the claims that are valid at the end of the day, but they're not going through the paperwork and making sure the T's are crossed and the I's are dotted. There's a couple of questions as for what the premium specifically costs, either in this example or elsewhere. As Kevin mentioned, each policy, each situation is different. Each policy is bespoke, and so the price will vary. I don't want to kind of give a range and then have someone contact me a week later and say, well, you said X, Y, or Z. It really does depend on a number of factors that we put into our system. But if there's a specific case that you're interested in or looking at, feel free to reach out to Kevin or me, and we can walk you through that.
You were happy to look at any scenarios, even how hypothetical in nature. They're happy to speak with you in more specific terms. So CASI is really a solution to ring fence the financial risk of settlement in a class action matter. I'm going to turn it back over to Ross to discuss another product, which is a little bit more robust, that businesses can leverage to ring fence entire litigation risk and cost. And with that, we move on to litigation buyout insurance.
Great. So litigation buyout insurance, which we sometimes refer to as LBO insurance, provides companies with the ability to ring fence litigation exposure and transfer the full financial risk of litigation. With LBO insurance, the carrier takes on the financial risks and liabilities for the business involved in litigation at any time before settlement in exchange for a known fixed cost. In the context of an M&A transaction, for example, LBO insurance can negate the requirement for the use of large escrows or indemnities, and it helps provide certainty and finality to both parties to the transaction. How does it work? Cases where settlement is not an immediate option, or there's business reasons that make time of the essence, LBO insurance helps provide a clear path to getting some certainty. In exchange for the insurance premium, the carrier will take over the defense of the litigation, take financial responsibility for defense costs, cover any adverse judgment. And as we note here, the limits are generally up to $100 million, but that can vary depending on the circumstances. In terms of the key benefits, it's almost obvious, but covering the financial risk of litigation, defense costs, and the adverse judgment can help ease a counterparty's worry if, for example, if you're in the middle of an M&A transaction, but the acquirer is concerned that a pending litigation might blow up and they don't want to take on that risk, and the parties are negotiating unsuccessfully, what type of escrow or the size of the escrow. Having an LBO policy in place can alleviate those concerns. Now, some points that aren't on the slide that I thought were worthy of explanation and clarification. For LBO insurance, the goal is to have the full litigation covered, but every policy has to be for an amount certain. So you can't buy an insurance policy that is open-ended or for all the cases worth. You have to actually put a finite amount in the policy per insurance regulations. So if you're seeking LBO insurance, you should consider how much in coverage you want and how you'd like to structure the policy to get the coverage that you desire to help achieve your business objectives. These calculations can include trying to figure out the interplay between retention and premium. In other words, do you want to pay more for the policy and have the insurer pay first dollar loss, or do you want to pay less for the policy and have the insured retain some of the risk through a retention. So these are the factors that we encourage folks to consider before coming to us looking for cover. Anytime you have an insurance policy, one thing to understand is that insurers will always insist on certain exclusions. This is just as a way of understanding kind of the process, and without getting into the nitty gritty on all of them, there are things like, if you have LBO insurance, the insured, can't simply enter into any settlement they want without the insurer's consent, which makes sense. And, the insured can't take on certain costs, like they can't go out and hire 42 different experts at a cost of $1 million each in litigation without obtaining the insurer's consent. Things like that help make sure the interests are aligned in the litigation. And finally, if you're considering an LBO policy, we always ask that companies consider, a few questions. One, is injunctive relief likely to play a role in ultimate resolution? And if so, how willing are you to enter into that type of injunctive relief? Two, is there a chance where you'll have to admit wrongdoing in a litigation? Could that be a problem for other cases, whether they're government, regulatory, or otherwise, that you're involved in? And three, is there, for a given case that a company is involved in, is there a principled basis on which you want to fight? Meaning, like, you don't want to settle because of the precedent that would result from a settlement. And so if you, are in that fight for the long run, the question is LBO insurance the right play for you, given that you want to, establish a precedent, take a case to trial, et cetera? That might not be a good fit. But the answer to these questions certainly will help you think through the case and how to view the case and whether LBO might be a good fit. And I think, to kind of provide an example, if we go to the next slide, we provided a short case study on LBO insurance. And this is one that I worked on. A private equity owned company was purchasing a retailer that had potential FACTA liability. I don't want to get into, we could spend the rest of this presentation on what FACTA is and how it works, but basically about whether the receipts that a company prints have personal information that should be protected under the law. Having the last 4 digits of your credit card is okay, having the last 9 digits is not. So we'll leave it at that for brevity's sake. The potential liability exceeded the enterprise value of the retailer. And so the buyer, in order to be assuaged to complete the transaction, wanted to ring fence the litigation. And so we were called in. We helped underwrite the litigation and outcome risk by assessing the merits, the defenses, the settlement opportunities. And we were able to procure an insurance policy within 2 weeks that arranged for full coverage to provide first dollar loss, and it helped save the transaction. And the result was a final insurance policy that covered an award or settlement of up to $20 million, inclusive of defense costs, for a premium of $4 million. And so, this was a case where, the company was really in a bind, wanted the transaction to go through, needed to move very quickly, and we were able to help them get there, get a result that they were happy with. We go to the next slide.
Ross, we have a question that came in, perhaps you can answer, from Rob Christopher. Can LBO insurance lawfully cover punitive damages and penalties? And if so, how commonly is it included? And perhaps the same question for our favorite wage and hour claims and claim recoveries in states like California.
Yes, at the risk of giving a very lawyerly answer, there are some complications that come with covering punitive damages. And so that's something that's at play in a case, something that certainly needs to be discussed with the insurer up front. With wage and hour cases, there are, again, different complications depending on what type of case, if it's a PAGA case or not, in terms of what type of recovery they're seeking or who brought the case. And so these are things that we look at and kind of wrestle with. We certainly have looked at a number of wage and hour cases. We provided coverage for them, including one on a prospective basis. But the devil is always in the details, and so we do a comprehensive underwrite. When a client comes to us with a certain risk they're looking to have covered, And, if the answer is no for various public policy reasons in the certain jurisdiction, then, we get to that result pretty quickly and let you know. But those are really excellent questions. So thanks, Rob.
Yeah.
Okay. So moving on to the next slide, judgment preservation insurance. So what is judgment preservation insurance? Well, as the name suggests, right, with any significant trial court judgment, there is always a risk on appeal that an appellate court will reverse in whole or in part and ultimately reduce a damages award. JPI is for the plaintiff in a situation where the judgment is up on appeal, who's looking to guarantee a certain minimum level of recovery so that they can, help with their internal budgeting process or their expended costs in the years to come. But it's a way of taking some of the risk off the table to immediately leverage the financial benefits of the award. Now, just to clear one thing up, right? JPI can be used for some or all of the judgment. So if you have say you've won $100 million jury verdict on a case, and you're looking to lock in, you don't have to lock in for the full amount. You could say, well, there's a $20 million in compensatory damages and $80 million in punitives. And, we understand there's grave risk with the punitive damages being lowered on appeal, but we'd love to lock in the compensatory damages so we have that certainty that at the end of the day, we're going to have that $20 million recovery. And so you can buy a policy covering some or all of the judgment, which obviously can be a useful hedge for the company. Now, how does it work? You first determine if the company's judgment is appropriate for JPI. The most insurable cases are those with solid appellate legal issues and large judgments. The company comes to us. On behalf of the carriers, we conduct an underwrite of the risk, which requires diligencing the record and assessing the legal and factual issues. And if we can get comfortable that we think there's a high likelihood that the judgment will be upheld, again, in whole or in part on appeal, then the carrier will propose pricing and policy terms. And if the company and the carrier can reach a deal, the company will pay a one-time premium in exchange for the JPI. Key benefits, of course, provide certainty, takes some of the risk of appeal off the table. It can help alleviate litigation fatigue, something we see very commonly, and I certainly saw as a practicing lawyer, is that, plaintiffs can, they get to the end of a trial, they win and they think it's over, and then they're told that it could be another 1, 2, 3 years before all the appeals are taken care of. And if the case is remanded, it could be even significantly longer than that. And so this helps alleviate some of that litigation fatigue by allowing a litigant to, lock in a certain amount of benefit. And it can also augment additional monetization options. Oftentimes JPI is paired with, either monetization or funding, where if there's insurance guaranteeing a certain minimum result, that insurance can be leveraged to help a client monetize immediately so that there's actually cash coming in from a third party. And gets a little bit complicated a little bit quickly in these kinds of situations, but the money can, the non-recourse money can come in. It can be collateralized through the use of the judgment or the JPI, and everyone kind of goes on their way. And the win-win situation here is ultimately at the end of the day, the judgment's upheld and everyone's happy. The funder's happy, the insurer is happy because they're off risk, and the litigant's happy because they got their money a lot sooner than they would have and allowed them to achieve certain business objectives they might have had. So quickly, we've got a lot to cover and we're only down to 10 minutes, but if we go to the next slide, there's a JPI case study. This is a case that when risk settlements was engaged, where plaintiff attorney had won a $200 million judgment in excess of $200 million in a class action and was seeking a loan of $10 million to cover expenses during the appellate process. A litigation funder that was not us, unrelated to us, was willing to provide a non-recourse loan, but wanted certain protections. We reviewed the merits of the case and ultimately were able to help issue a $10 million JPI policy in favor of the litigation funder in exchange for a one-time fixed premium. And with the downside protection in place, the litigation funder provided the loan to the plaintiff's attorney, who was able to continue pursuing the case through the appellate process. Ultimately, at the end of the day, this case resolved, allowing the funder to recoup its money, taking the insurer completely off risk. And so this is one of those situations where the insurance kind of helped all the parties get to a good place in this transaction. So with that, and with the 10 minutes remaining, let me turn back to Kevin to talk about adverse judgment insurance.
Yeah, so thanks, Ross. So adverse judgment insurance is really the converse of judgment preservation insurance. Typically, adverse judgment insurance is purchased by defendants before their case has gone to judgment, but it is not triggered until there's a final judgment and then there are no further chances or opportunities for appeal. It's normally leveraged to protect against catastrophic outcomes that could actually exceed what the company's current insurance limits are, what their current risk tolerance is. It can really be purchased at any stage of the litigation, whether there's known, threatened, or pending litigation. However, one of the more common applications, or I should probably say the most common application, is to actually leverage it during an M&A transaction when the acquisition target is facing litigation liability and they're looking to avoid that onerous escrow or the indemnity requirements that could threaten the transaction or cut into the proceeds of the sale. So AJI can be actually leveraged to really just ring fence and de-risk that litigation by transferring it to the carrier. So that's one of the most common applications, but how it can also be used to really protect or restore shareholder confidence or a company stock price when there's concerns over litigation. And we've also seen it actually be used and be leveraged in order to gain some advantageous settlement positions and to help defending businesses negotiate from a position of strength and push a little more aggressively to obtain a cost-efficient settlement for the business, because the company has this backdrop of protection against them that would save them from any real catastrophic injury or loss. So how it works, we have to determine whether or not the case is really appropriate for AJI. As with JPI, the most insurable cases are the ones where there are solid meritorious defenses, but then we would work with the carrier. We would look to do an underwrite of the risk, diligence the record, do a SWOT analysis of all the legal and factual issues, and then do our risk assessment and our risk modeling and propose pricing and policy terms for a one-time premium to take on that risk. I think that's really the last insurance vehicle we have. Now, as we wrap up in the last 5 minutes, we can move on to litigation funding and litigation asset monetization, which also ties back to.
So Kevin, we can actually go to 1205 as Shai just mentioned, which
okay.
is good.
Oh, okay, so we've got time. Great. All right.
A couple of good questions that I'm seeing in the chat. Let me just start with the last one from Neil. Am I correct in assuming these policies are all discoverable? What impact on settlement values if a plaintiff knows the defendant has likely coverage? Just in brief, certain policies certainly are discoverable. Litigation buyout insurance, where the risk is, who owns the risk is transferred. That is in all likelihood a discoverable policy. Class action settlement insurance, on the other hand, is not. It's not a policy that covers an ultimate judgment in the case. It's a policy that ultimately covers the claims that come in following a settlement. So that's not generally a discoverable policy. As to the second part of the question, what impact on settlement values if a plaintiff knows that the defendant has likely coverage? This is not an uncommon occurrence. I mean, there's generally, in securities fraud cases, most companies have some form of D&O insurance that will cover some of the litigation or some of the liability. And so that's generally disclosed fairly early. And, like most policies, with respect to the ones we've been talking about here, they're judgment only policies. So it's not that there's, free money available from the insurer whenever the plaintiff wants it, but rather it's, in the event that the case goes the distance and there's a trial or, ultimately a judgment, and it's going to have to go through an appeal to pay out under the policy. I don't think, the plaintiff is going to view that as, free, easy money, from the insurance context, but it's a good question.
Great. So moving on to litigation finance, or perhaps a lesser known use of litigation finance, affirmative asset monetization, or sometimes commonly referred to as claim monetization. The concept itself is relatively simple and straightforward. It's basically when a litigation funder offers non-recourse capital to a company in exchange for a portion of a future economic recovery for a legal claim that they usually have against another business. Basically, it's converting a latent litigation asset into cash now so that the business can realize an immediate boon to their balance sheet. And I say normally it's one business against another business because while this could be leveraged for any type of litigation, it's usually best when applied to things such as like commercial arbitration or large B2B contract disputes. We're involved in a lot of monetization of IP disputes and patent infringement cases. And then in large part, and this goes to the case study I'll discuss in a minute, antitrust class action cases, or I should mostly say when businesses opt out of the classes and antitrust class action litigation to pursue individual claims and are willing to actually sell their individual claims for cash up front. But I did want to go back to the survey because we asked a lot of questions about affirmative asset monetization or claim monetization. And I saw when we did the initial poll that a lot of people were not familiar with it. Whereas I think across the market as a whole, we did receive a fair number of responses from the survey, from the 200 respondents that we received. 1/3 of them actually were pursuing affirmative asset recovery opportunities, which actually is a relatively small number. We thought it would be bigger, but that actually correlates to the other issues that we saw, that most in-house departments are understaffed and had tight budgets as well. Then we asked another question, which was, how many would take advantage of AAM opportunities if they were made aware of them, regardless of the size? And there was 50, almost 60% of the respondents said that they would take advantage of them. And the reason being is that they could leverage this as a way to actually turn, as Ross alluded to earlier in the presentation, turning the in-house legal department from a cost center into a profit center. And so with that, I think we have, well, let me review the case study on asset monetization, and then we'll go on to a poll question before we move on to wrap it up. So during COVID, we were working with a large national fast food retailer. They were having some financial cash distress, as most businesses were, just simply because things were locked down. They were running out of cash. Aside from the COVID relief they may have been receiving from the government, they needed an additional cash infusion, but they weren't able to get that through banks, through traditional lending structures. And so we were reaching out to them. I'm not sure if anybody on the call, I'm assuming many people on the call are familiar with much of the antitrust litigation against some of the nation's largest producers of meats and proteins. There's been class action litigation against tuna, salmon, broiler chicken, beef, pork manufacturers. So during COVID, the claims against the US manufacturers of broiler chickens was really heating up. And so we worked with this one organization that was in the supply chain from them, stemming from some antitrust actions precluding and price fixing and overcharging. Anyways, they had some claims against the largest manufacturers, and they were interested in working with us to actually monetize those claims, to transferring to us a portion of the proceeds they would get once they were prosecuted to their fullest in exchange for cash up front. And so we were able to work with them to provide them with $3 million upfront, non-recourse funding to help them improve their cash flow and stay afloat until the doors reopen after the pandemic. So with that, let's get to our last poll question. Are you currently pursuing any affirmative claim or affirmative asset monetization? And if not, would you be interested in pursuing these opportunities if you were made aware of them? So we're collecting most of the respondents. So are you currently pursuing any affirmative asset claim monetization? Only 3 out of 67 respondents were, but We received a much larger number. About half of all respondents, about 36 of you out there, said that you would like to learn more before you considered pursuing these potential monetization opportunities. So very understandable. And again, if anyone would like to reach out to Ross or I to learn more and discuss our history of work, our extensive work in the space, we'd be happy to speak with you. So let's go ahead and close out this poll. And then we're going to go ahead and move on. And I'll move on to Ross to wrap it up with just an overview of litigation funding.
Great. So thanks, Kevin, and thanks for everyone for participating in the polls and asking some really great questions. The presentation's gone on. I think anytime it's more interactive, it's certainly better. And so we really appreciate that. Let's kind of finish the presentation with a short overview on litigation funding. This, as we established in the first poll question, or the second question, is the most well-known of all the things we were talking about here today. This is litigation funding is the mechanism or process through which litigants, whether it's the plaintiff himself, herself, itself, or the plaintiff law firms, can finance their litigation or their legal costs through a third-party funding company. And in return, the third-party funding company charges interest on the loans and or shares in the participation of funds recovered from the litigation, if any. Generally, this type of funding is non-recourse. And it can be used in any type of litigation. And so how it works is at a very high level, funders will take a look at the case, whether it's at the early stage or midstream, look for strong claims that would justify the money that's being sought. And funders will then have to do their own diligence, not just on the claims, the merits, the quantum of damages, but also certain things like collectability. How likely is the defendant, if they were to suffer an adverse judgment, would be able to pay? And if those, if the initial investigation returns results that are positive, funder can propose terms for the loan, which will include certain things like timing, structure, economic terms, and the parties enter into an agreement which lays out how it will all work. Now funding, just to provide some interesting points that aren't on the slide, funding can take on many forms. It can be used to pay lawyers their traditional hourly rate. If the lawyers are on contingency, it can be used to pay lawyers expenses, which can be sizable. For example, experts, trial technology, et cetera. As I noted, it's almost always non-recourse. Funding can be used exclusively for the litigation, or in certain circumstances, it can be used by the party receiving the funding for certain company-related activities, for example, capital expenditures. Funding can be distributed at once, meaning there's a certain amount negotiated and that amount is transferred to the company to use for the litigation, or it can be distributed in tranches. And in that situation, that scenario, it can help provide a hedge in case there's a bad early result. The funder is only out the certain tranche that's been forwarded initially, not the full amount of potential capital that could have been available. And the funder's returns, the way that the ultimate waterfall structure would be set up are heavily negotiated. And at the end of the day, usually consist of either a multiple of the amount funded or a percentage of the recovery. And at the end of the day, whether the funder gets the greater of those two aspects, is one of the points that's ultimately negotiated between the parties. It is now 1:05. We have more stuff to cover, but I think in the interest of time and everyone's lunch or breakfast being done, we will pause right there to say thank you to Shai for having us today. We've really enjoyed sharing this information with everyone on the CLE. Thanks to participants again for asking great questions, and Kevin's and my contact information are up on the screen. So if you have any questions for us, feel free to call, email, shout from the rooftop, whatever it may be, and we'll get back to you promptly. But thanks, everyone.
Awesome. Thank you, Kevin and Ross. You took all the questions from the chat box in real time. We don't have too much right now to go over. So folks, if you have questions or comments, please put it in the chat. I guess I will ask a question. Are there any industries or areas of law, I guess like antitrust, that are particularly hot right now, or, that, in-house counsel should generally be aware of? Any exciting trends you can share with us?
Yeah, I think, it's a great question, Shai. I think the short answer is, just to pick a few of the things we've been talking about, on the claim monetization side, being in tune with the various big antitrust matters that are making their way through the system is really important. I know sometimes what we hear from in-house attorneys with whom we speak is, they're so overwhelmed by the defensive work on a day-to-day basis, fighting away demand letters, litigation, complaints, et cetera, that there's not enough time in the day to pursue affirmative claims that might actually bring money in. And so, there are advisors out there who can help. We can help, others can help in terms of monitoring cases. If you're, as Kevin mentioned, if you're in the food industry, understanding what's going on with antitrust cases against pork distributors or manufacturers, salmon, tuna, chicken, et cetera, understanding all those, or if you buy materials that are distributed through the rail and you paid for those costs, understanding the antitrust case that's going on against the rail company. There's a lot going on that, in the antitrust context that could ultimately, at the end of the day, provide much needed capital to companies, if they know how to act. And it's not just filing a claim in a lawsuit. It's, understanding the full panoply of opportunities that are available, including opting out of settlements to partner or band with a number of others to try to get a better deal in a private settlement than being part of the class. So there's lots of things to think about on that front that, we're happy to talk to folks about if they have questions.
And I would just add that more on the class action settlement insurance front. I mean, the area where we're seeing just a lot of our business right now is pertaining to consumer goods or consumer brands, advertising litigation. It's just a huge, rapidly growing area. Then also in terms of TCPA litigation as well, that's definitely a less of a quantity matter after the Facebook decision. I think the Facebook decision weeded out a lot of the weak cases. But what you have right now is a lot of the auto dialer and a lot of the DNC cases, where there are some truly viable, substantial claims and some real liability. And there can be some significant liabilities that pile up very quickly under that statute. So those are some two hot areas for us, at least when as it pertains to the leveraging of our settlement insurance product.
And it looks like Carla had a question about whether LBO or adverse judgment insurance are appropriate for small companies that are sued by individuals in employment litigation. Again, good question. At the end of the day, for a carrier to want to cover something, the quantum is going to have to be there. And so, again, not to punt on the question, but at the end of the day, it's really going to be how big is the litigation? An individual suing, whether for a relatively small amount, insurance cover is going to be somewhat less attractive from the insurer's perspective if there's not enough quantum there. But if there's a question of a live case, we always invite you to come to us and we can talk through that.
What about copyright infringement? And, are you seeing any trends develop with that? Like, I know there's a lot of action in the ISP, internet provider, copyright infringement realms. There's also mass arbitrations. Does Risk Settlements do any, work in those two areas?
Yeah, let's start with the second one. On the mass arbitrations, that's certainly been a hot topic. I know, the Keller Lankner firm has been doing a ton of work on those with filing thousands and hundreds of thousands of cases against some big companies, trying to use the arbitration rules and the provisions in their contract to their advantage. We haven't been dealing with that. And I think if anything, again, without any inside information or anything on those types of cases, that's, I think, if anything, more prone to a traditional funding, where lawyers might, again, I don't know anything about those cases, but lawyers might be seeking funding to help, bring those cases and stay with them for the years to come. But that's not something that we have looked at. And on copyright, again, that's a topic area that's certainly very interesting, but that's not something that we have seen a lot of interest, from folks that we're in touch with coming to us for help with, but not to say it couldn't happen.
Okay, cool. So I think to wrap up, why don't we go back to developing the right litigation strategy slide, take us through it. And then after that, we will, if there's no other questions, we'll do a little bit of virtual networking, and then we'll go from there. It's a beautiful slide, great information on it. I don't want to miss it. Certainly people are sticking around. So let's wrap up there and then do virtual networking.
Great. Kevin, you want to jump in on this?
Sure. So basically, I mean, this is largely just an overview of as Ross alluded to at the beginning, formulating the appropriate litigation strategy. I think the overarching really message that we wanted to offer to the audience here today is that in large part, litigation has been binary for quite a long period of time. It's, do you defend? What is your litigation roadmap? What is your strategy? When do you settle? However, now there's been a paradigm shift, and so now businesses and their outside counsel have a risk transfer optionality to consider, and whether that optionality pertains to transferring the risk of a settlement in a class action case, or if it's ring fencing potential liability that's uncovered while you're diligencing an M&A transaction so that you can complete the transaction and not worry about escrow and indemnity issues. There's a solution for you there. If you're a plaintiff's lawyer and you have a significant judgment and you're worried about risks of that judgment from post-trial motions or on appeal, and basically you're interested in ring fencing the appellate risk, there's a solution for you there. So we basically created this suite of both plaintiff side and defense side solutions, which involve the aforementioned insurance vehicles, which all transfer unknown contingent litigation liabilities and litigation risk, all the way to funding solutions, which can give you cash up front and which can also serve to de-risk some of the potential litigation that you're facing, or can be combined into hybrid structures where you leverage funding, financing, monetization, along with insurance to achieve both a win-win. The overarching goal is to de-risk litigation and to provide cost certainty for defending businesses or your counsel, regardless of the type of case or which side of the V that you're sitting on. So kind of a holistic rambling, a summary of what's on this slide without going down bullet by bullet and reading through it. But again, very appreciative of everybody's time and attendance today. It looks like we had a great audience. I can see that a lot of people are still sticking around. Great question, great responses to the polls. Thank you very much for making it interactive. And we look forward to sticking around and having a little virtual chat. And by all means, feel free to follow up via email, phone call, or LinkedIn. We love the opportunity to speak with you after the event today. Thank you.
All right, fantastic. So thank you again, Ross and Kevin.